What's up everyone, welcome back to another video with the Millennial Finance. Stock markets have been in a pretty rough patch. If you're invested into high growth stocks like myself, then many people consider it to already be in a bear market since February 2021. I mean, take a look at ARK Invest's flagship fund, which is the ARK Innovation Fund, which many people consider to be the benchmark for high growth stocks. It peaked right around February of last year and it has been in a steady downtrend ever since, with it being over 50% from its all-time high. Even though there's a lot of doom and gloom out there, I think that this is slowly shaping to be a really good buying opportunity, especially for younger investors like myself. Let's go through why. Cha-ching! Something about human psychology just makes us bad investors. When things are going to the moon, everyone is ready to hop onto the train, they're excited and they want to buy. When things are dropping like it is now though, then suddenly no one wants to be an investor anymore. Even I'm guilty of this. The thing is, many investors make the most money buying when it's low. Duh. Even in terms of activity on our YouTube channel, we saw many people who wanted to start investing or invest more of their money towards the end of 2020 and into early 2021 when literally every single market was flying. Now, less people are interested, probably due to the fact that their portfolio is in losses and they just don't think investing is for them. The most money though is made right after bear markets or corrections. As the bear market or correction has already been going on for a while, I think that it's about time we start preparing for this next leg up. As usual, this is not financial advice. At the end of the day, it is your money, so make sure that you do your own research before making any decisions. Anyway, first things first, we gotta acknowledge why stocks are dropping so much in the first place. Firstly, we have to acknowledge that valuations were definitely too high. Many people were already calling a top early last year because there was just so much liquidity going around that caused stocks to go up way too much, way too quickly. Seasoned investors who have gone through many bull and bear cycles did say that 2020 and 2021 to an extent were definitely not normal years for the stock market. Of course, being a relatively new investor myself, I didn't trust these calls, and as I said in a previous video that I did last year about my investing mistakes, I didn't make the adaptation fast enough. With valuations so high up, it was bound for a decline, especially for very high growth stocks like software, e-commerce and fintech. Secondly, the lockdown-led infusion of cash just meant that inflation was bound to happen. As I mentioned before in an earlier video as well, higher inflation is usually counteracted by central banks with higher interest rates, which is usually not so good for the stock market. Finally, we also have the current unfortunate events that's going on in Russia and Ukraine, which is causing some cautiousness from investors. The good thing is that while there are some uncertainty in the stock market right now, we can always look back at historical events to see how the stock market reacted after that. Again, you all need to know that just because something happened in the past doesn't mean that it will also happen in the future. However, it is a good benchmark for us because this is the best way that we can sort of evaluate how things will go into the future. The first thing is that bear markets happen on average every 3.6 years. So this is completely normal. This means that if we have a 40-year investment horizon, then an average individual will go through 11 bear cycles. Every single bear market in the past so far has been followed by an even stronger bull market, which is why we get the average 7 to 8% returns on the S&P 500. On average, bull markets tend to last longer and give more returns to offset the bear cycles. Some investors even say that every single bear cycle that we meet is an opportunity for investors, meaning that we will have 11 such opportunities in our lifetimes. For that reason, I was also holding some cash in my portfolio. I didn't immediately invest all my money when the S&P 500 was just going up every single day because I knew that this was bound to happen and I wanted to have some powder to deploy. Another thing that we also know is that the fastest growing companies in terms of revenue and earnings usually correspond with the highest return on investments. Of course, this depends on your valuation and all that, but usually this is the case. So what can we do about all of this? As I said at the start of the video, stock markets in the US have officially entered a correction, which means they're down more than 10% from their all-time highs, while certain segments like high growth stocks have been in a bear market, which means a decline of more than 20% for over a year. Because of this, I will consider it to be one of the 11 opportunities that we will have in our lifetime. I know many people who wish they invested money or invested more money in March 2020 when they started seeing the stock market skyrocket. Of course, we don't expect those kind of returns from the low anymore because 2020, like I said, was not a normal year for stocks. However, we still should see a good return on our investments. There are many great companies out there like Facebook, Alibaba, and Square, which have been absolutely destroyed in terms of stock performance. However, not much has materially changed for these companies fundamental-wise, and I see many great bargains starting to form out there. Still, just like how valuations went a bit too high in the last bull cycle, a bear cycle should also see valuations go a bit too low. This means that just because a stock is so far off from its all-time high and the valuations look so cheap, doesn't mean it can't go even cheaper. Since no one can perfectly time the market, then the best approach will be our good old friend dollar cost averaging. And that's exactly what I'm starting to do with my cash, slowly entering into new positions and adding to my existing ones. I also follow many respected investors on Twitter, and they also mentioned that they're starting to slowly dollar cost average into their positions. This would be the safest bet, and like I said, since stocks are technically on sale, it is a pretty good time to start your investing journey. Another option that you have is to basically trade into stocks that are doing well in this current climate. This includes stuff like gold, oil, and agriculture stocks, which generally do well in a high inflation period. The goal here is of course to invest in these companies because they are doing well, sell close to the top, make lots of profit, and then use this cash to buy into the long-term holds like the high growth stocks. This is more for advanced investors, so it's probably not so relevant to most of you. Late last year, I shared a video about the updates of my portfolio, and I basically mentioned that I'm splitting it into two, being a long-term investment portfolio that I wouldn't really touch and a short-term mod of trading one. This trading thing that I was just talking about is exactly what I'm doing in my shorter term portfolio. Just based on some technical analysis and some investing styles that I follow, I have some money invested into oil and agriculture, which at the moment are doing pretty well. So I'm taking the profits where I can now, but these are not really companies that will invest for the long term, 20, 30 years. What I plan to do is hopefully make some profits for once trading and then take this money, put it back into my long-term portfolio and buy more of the companies like Facebook, Amazon, and Google. For the majority of you though, stick to dollar cost averaging. I doubt you can go wrong with that, and it's a much safer option. Whether it's buying stocks through interactive brokers or Rakuten, or investing through a robo-advisor like StashAway, that's completely up to you. If you haven't signed up for those platforms, then check out some links that we'll leave in the description below so you can have a look at the options for you to start investing. So to wrap things up, I think that we're getting close to a good opportunity for stocks, especially for those in certain sectors. The best way to navigate the current uncertainty is by dollar cost averaging into your portfolio and not staying away completely. If you're thinking of selling off all of your stocks, then I would say that would be a good play 6 months ago, but not so much now. If you haven't started investing your money at all, then now is actually a perfect time for you to do so. Like I said, we'll leave some links down in the description below. Check out the different options that you have depending on your style. Thanks for watching this video to the end, guys. Give us a big thumbs up and subscribe to our channel if you haven't already. See you guys in the next one. Peace out.